So, welcome to your part 2 of your irrecoverable debts and allowance for receivables for your ATI Financial Accounting Year 1. We've got this longer question now, 13 marks. Okay, so this 13 mark question, you'll see that part 1 and part 2 are very similar to what we did before. We're asked for the allowance for receivables and we're asked for the irrecoverable debts T account. Okay, so that's 7 marks, very similar to what we did before, with the exception that we actually have some recovery. Here we go. Some recovery of debts previously written off. Okay, so with that exception, that's something new that we hadn't seen in our short question that we did before. So I want you to take a moment just to read through the question. If it is a thing that you have the paper in front of you, well and good, just have a good read. If not, just pause the recording and have a read from the screen. So take 2 or 3 minutes there to have a read through the question, remembering that you will have, for this piece, 13 multiplied by 1.8, you'd have 23 marks for this particular part of the question, 23 marks for this question if you were in your exam. So I'm going to assume that you have paused the video or that you've taken the time to read your question, and then we'll crack on with the actual question itself. Okay, so I'm going to do some calculations first. Then I'm going to do my T accounts, then we're going to have a quick chat about why we would set up specific allowance for receivables, and then we're going to look at those extracts from the financial statements. Okay, so first and foremost, let's have a look. I'm going to go back and it's going to look very similar to what you saw before in your short question when I'm looking at my Excel to do my calculations. I'm going to start with my draft receivables. I'm going to deduct my irrecoverable debts, draft irrecoverable debts written off during the year, draft irrecoverable debts written off during the year, allowance for receivables. Okay, so I'm going to start with my debit balance and then I'm going to look at these extra notes. Once again, note that everything up here has been previously accounted for. Okay, it's been previously accounted for. So in that particular case, this 632,150 has already accounted for the 48.5, the 41,210 and the 3,520. That's already within that 632,150 figure. So it's only these ones down here that I'm going to look at accounting for outside of that 632,150 figure. Okay, so I'm going to start with my 632,150 balance, and then my first one says an additional 11,790 of debts should be written off as irrecoverable. Okay, so I'm going to deduct that 11,790 from my 632,150, and that's going to be my starting point. So let's do that first. Actually, I should be able to just pull this over. Yep, I am indeed. Okay, so I'm starting with that figure of 632,150. So that's my draft receivables balance. I'm going to deduct that extra 11,790, and that's going to give me my receivables balance that I'm actually going to write into my statement of financial position. So 620,360 is the figure that I'm actually going to see in my extracts from my statement of financial position. Okay, so then I might have an allowance for receivables that's going to go under that, but this figure here, that figure is an actual number that I want to physically see on the face of my statement of financial position. So this figure I'm not going to see because that's written off, it's gone. I've got to forget about it. So this is not a correct figure, it's not a prudent figure to put on. It is this minus this that I want to see. So my 620,360 is the figure I want to see in my extract from the statement of financial position. Okay, so let's just pop back again then and see what did it say next for us. So we've dealt with the first item. Okay, so let's pop over here. We've dealt with the first item. The second item then is that G. Duncan considers that 15,380 of debts should be made the subject of a specific provision. Okay, 15,380. Okay, 15,380. So my specific allowance is 15,380. Okay. That means that 604980 is the subject of my general allowance. Okay, do you remember we said go with the write-offs first, then the specific allowances, and only when you've taken both of those off are you going to figure out your general allowance figure. Okay, so let's come back and just have a look at that. And it says that the general allowance for receivables is to be 5% of the remaining balance. Okay, so it's 5%. So in this case, I had multiplied that by 4 in my previous one, so I wanted 5%. So my general allowance of 5% is going to be 30249. That's going to be my general allowance. So my allowance for receivables is going to be, let me just change this colour a little second here. My allowance for receivables is going to be this guy plus this guy. Okay, so my allowance for receivables is equal to this plus this. Okay, so the allowance for receivables that I want to end up with, again on my statement of financial position, is 35629. Okay, 35629. And if that's the case, then I want to know what is the difference between that allowance for receivable and the allowance for receivable that I started off with. So the figure that I started off at the beginning of the year is this figure here. So I'm going to say that I want this 48500. That's the one that I started off with. That was my allowance for receivables from the previous year. Okay, so the previous one then is 48500, and the difference between the two is 2871. Okay, so I'm going to need all of those numbers. I'm going to need my receivables balance for the statement of financial position. I'm going to need my allowance for receivable figure. I'm going to need my difference figure, which is this one here, and I'm going to use this previous allowance as my opening balance on my allowance for receivables. Okay, so I'm going to need all of those figures, and that would basically be, you could practically learn that calculation off, and you wouldn't be too far wrong, because your calculations are going to be roughly those calculations, maybe with some alterations. Let's say, for example, if there was an irrecoverable debt that had been paid and had not previously been accounted for. Okay, so let's just go back to our question for 1 second. Okay, here we are, and we're saying that you've been told this was the draft receivables. The previous allowance for receivables was 48.5. Draft irrecoverable debts written off during the year was 41210, and irrecoverable debts that had been previously written off and then recovered were 3520. Okay, so then we had an additional 11790 that needed to go with this write-off. We had an additional 15380 that was going to go with our allowance for receivables, and then we wanted 5% of the remaining balance for our general receivables allowance. Okay, so all of those things being the case, now let's go off and have a look at writing up our allowance for receivables account and our irrecoverable debts account. Okay, so let's go to our T accounts here. So our allowance for receivables first. Remember what we said before, that an allowance for receivables reduces your asset. So what we're going to do is we're going to say here, we're going to say the balance carried down is the figure that you started off with, which is the 48500. Okay, that was at the 1st of January 2015. Okay, that's the first thing that we're going to do. Now, we saw that there was a reduction. Go back to our calculations. There was actually a reduction in that allowance. So I want to make that allowance less. So I'm going to go to T Dungan here, and I'm going to go to income statement. So I'm going to reduce, it's going to be debit the expense, it's going to be credit the expense and debit the allowance for receivables. So I'm going to say to my income statement, I'm going to go 2871, which was the difference. Okay, so look at that again, 2871. That's reducing. So my allowance for receivables at the end of this year is going to be less than it was at the beginning of the year, so I'm reducing that expense. Okay, an expense would be a debit, reducing an expense would be a credit. So in the T account, it would be, if we were looking at the expense account, it would be credit the expense, and it would be debit the allowance for receivables. Okay, so there we go. We've got my 2871. Okay, and therefore the balance, so if I'm going to total this, both sides have to be 48,500. So my balance carried down is going to be equal to, pardon me, this one minus this one, which is 45629. 45629. Okay, and let's just go back and make sure that that's the number that we had. So when we did our calculations, 45629. Okay, so just as a double check, if you use this and you then get your balancing figure, it should be this figure. Okay, so we've got 45629 and we're happy with that. We know that's the right figure, and that is the figure that we're going to see as our allowance for receivables, in the statement of financial position. So let's just highlight that guy. Now, let's have a look over here then. We're going to talk about the irrecoverable debt account. So we're going to start here. So we're going to deduct from receivables. Going to deduct from receivables the first figure we were given, which was 41210. We're also then going to deduct from receivables the figure of 11,790. Okay, so irrecoverable debt here, when we're looking at it, it's an expense of doing business. We have our 41210, which was the draft figure. We've our 1170, which was to be written off then later. We also need to account for the allowance for receivables, which was reducing this expense. Okay, so we've got, I'm going to say reduce allowance for receivables. I'm going to make that wrap, and I'm going to make it a lot smaller so that we can, okay, and the reduction there was 2871. Okay, 2871. So what is the figure then for our statement of profit and loss, or our income statement? Okay, let's total both sides again. So that's 5. Okay, sorry, 1 0 too few. Okay, so to the income statement is going to be 50129. Okay, so I'm going to highlight that guy. Now, so what are we trying to say here? We're saying that the irrecoverable debt expense that we had in this particular instance was 21210 plus 11790. Okay, but we also then had to reduce that expense by the fact that we reduced our allowance for receivables. We reduced our allowance for receivables by 2871. Okay, so remember when we were looking at, hold on till I just pull this back now to make sure that we're all in the loop on this. Do you remember we said that in subsequent years you could have an increase or you could have a decrease? Okay, in this case we had a decrease, so we debited the allowance for receivable with the difference only, and we credited the irrecoverable debt with the difference only. Okay, so again, when we look at our guy here, we credit the irrecoverable debt, which is the expense. We're reducing the expense. Okay, so now again go back to our question. Our question said that we had draft irrecoverable debts written off during the year of 2 41210, and then that we also had an additional 11,790 of debts then. So with our 11,790 there as well. Okay. We're talking about having some numbers here, and we're going to see these in our extracts in a few minutes. But we've got our allowance for receivables account, which is a reduction of an asset, and we've got our irrecoverable debt account, which is an expense of doing business. Okay, so you'll always have a certain number of people who won't pay you, and you need to take that into account. You need to allow for that as a business expense. Okay, so the next question that they had for us was to outline your understanding of why people might have a specific allowance in their books. Okay, now it says that a specific allowance is set up when a business has a specific concern that a debt owed to them may not be recoverable. So remember that your allowances are about doubts. They're not about knowledge, they're about doubts. Okay, if it was about knowledge, it would actually be written off. So the business may have the knowledge that the receivable is having financial difficulty, the debt may have been owed for a long time, or the receivable may be disputing that balance. So let's say, for example, we had delivered some ornaments and those ornaments were broken. Okay, we might not expect then that we're going to get that money. So therefore, a key difference in the general allowance and the specific allowance for receivables is that the specific allowance will be tied to a list of specific receivables as opposed to the general population of receivables. Okay, so we think 2% of people overall will never pay us in any case. Or indeed we might think that a specific person may not pay us. So specific and general. Always deal with your specific before you deal with your general. And once again, what they don't say there, which I'm just going to roll down, did they say? No, they don't. What they don't say there, and they should say, is that this whole idea of allowances is all about prudence. It's the prudence concept. That's why you would make your specific allowances and your general allowances, because you want to be prudent about what you genuinely think you're going to collect. Okay. Final question then was to show your extracts from the statement of financial position and the income statement. So I'm just going to click down here to my extracts. So what would I see in my extract for the income statement for year ended 31st of the 12th? I want to see my irrecoverable debt expense, and I want to see my irrecoverable debts recovered. Okay, and in my extract from the statement of financial position, I want to see my receivables and I want to see my allowance for receivables. So let's go for the easy one first. Let me find my receivables and my allowance for receivables according to my calculations. Okay, so my receivables balance is 620360. Okay, 620360. Just pasting the numbers there. And my allowance for receivables then, so what do I think that I'm not going to get paid? General allowance for receivables is this figure. So that is, pardon me, because that's a minus. That is what you would see in your statement of financial position as it relates to your receivables. Okay, so we're happy enough with that. Now my irrecoverable debt expense, I'm going to go back to my T accounts. So my irrecoverable debt expense is my 50129. Okay, so copy that. That's my expense for this particular year. Oops, there we go. And then my, bad spelling there, my irrecoverable debt recovered then is that figure that we were talking about before, which is equal to, and again it's going to be a minus because we're taking it off here. That irrecoverable figure was 3520. Okay, so that's what you would expect to see. So here's my expense in this particular year, and then I'm going to show my irrecoverable debt recovered separate from that. Okay, so when I go back to my T accounts, what I would have expected is that there's my irrecoverable debt account and so on and so forth, and then I could have had a separate irrecoverable debt recovered account. Now, you weren't asked for that irrecoverable debt recovered account. You weren't asked for it in this question, but you could have been asked for it. And what you would have been expected to do there is you would have your irrecoverable debt recovered account. And on the credit side of that account, you would have had your amount. What was the amount again? 3520 on the credit side of that account, because that would be reducing the expense that was a recoverable debt. It would also be possible that you would put that irrecoverable debt recovered on the credit side of your irrecoverable debt, in which case then you would only see one figure in your extract. So that 46609 would be in your extracts. But it is technically more correct to have your irrecoverable debt and your irrecoverable debt recovered in two separate accounts, because you want to see the expense for this year and you want to see then any expense that was written back into the books from previous years.